The financial crisis in the next 3 months. The devaluation of the US dollar is just the beginning. The real critical blow will be triggered within 90 days, at most 3 months from now. This is the final grace period the US government is giving us. If the Federal Reserve and the rest of the world still refuse to compromise, then what comes next will be a financial crisis even more severe than in 2008. In just this month alone, stocks and bonds have already caused pain for countless investors. But in less than 3 months, it may no longer be just stocks or bonds. The entire global asset market could collapse. And yet, during this exact moment, those who hold safe haven assets, will have the opportunity to realize profits and buy at the bottom of the market. What do I mean? Welcome to Fortune Strategy, my friends. Listen, you can forget your girlfriend's birthday or your wedding anniversary. At worst, you'll just lose a few Hermes bags. But if you forget this one important date this year, then the wealth you've worked hard to accumulate for years might vanish in an instant. That date is the last day of June this year. Why? Because the $6.5 trillion debt that the U.S. previously borrowed will mature at the end of June, precisely on the last day of the month. By then, we will see how the U.S. plans to handle this massive debt. You might think, what does America's debt have to do with me? Why is this such an important date? Many people still don't realize how serious this is. That $6.5 trillion debt maturing in June was largely borrowed during the pandemic. Back then, the economy was deteriorating, and U.S. stock markets even had to halt trading multiple times. During that period, the Fed kept expanding its balance sheet and pumping liquidity into the market, then lent this newly printed money to the U.S. government and capitalists at near zero interest rates. This means that the $6.5 trillion maturing in June carries extremely low interest, almost zero. But here's the problem. The U.S. Treasury now only has a few $100 billion left, nowhere near enough to cover the debt. So what's their only option? Borrow new debt to repay the old. But in recent years, the Fed has been aggressively raising interest rates. Right now, the U.S. has to borrow money at about 4.5% interest. What does this mean? Let me put it simply. Imagine I lent you $1 million 5 years ago with the agreement that you only need to return the same $1 million this June. No interest charge. You'd be thrilled, right? You could spend freely without worrying about paying any interest. But now you've spent all that money and you can't repay me. What do? You borrow $1 million from someone else to repay me, and now you're in debt to them. This is how debt rollover works. But here's the catch. The new lender demands 4.5% interest per year. That means over the next 5 years, you'll have to pay back not just the $1 million, but over $200,000 in interest too. Understand now, U.S. Treasuries work the same way. During the pandemic, America borrowed money at ultra-low interest rates and spent lavishly. Now the Treasury only has a few $100 billion left, and the $6.5 trillion in debt is coming due. The U.S. has no choice but to face this obligation. And if they can't pay it off, then they must borrow new money, but at 4.5% interest. So in June, the U.S. will have to transition from paying no interest at all to paying a very high annual rate. In other words, America is turning old, cheap debt into new, expensive debt. Currently, the Treasury only holds a few $100 billion, not nearly enough to meet expenses. It's estimated that by June, those funds will run dry. And at the same time, the $6.5 trillion debt needs to be repaid. If it can't be, the U.S. will have to borrow more at that higher 4.5% rate. Here's the most critical issue. Even if the U.S. wants to borrow, it's unclear whether anyone will still be willing to lend. Why? In the past, even with extremely low yields, people were still eager to lend to the U.S. For example, you might have $1 million in assets, And after 5 years, the U.S. only pays you back $1,002,000 total, principal and interest. That return doesn't even keep up with inflation. But still, investors competed to lend to the U.S. Why? Because U.S. bonds always appreciated in value. Previously, when you lent the U.S. $1 million, they gave you an IOU, a U.S. Treasury bond. You could take that bond and sell it on the market. Sometimes in just one trade, you could sell it for $1.1 million. That's because Treasury bond prices kept rising. So many people wanted to lend to the U.S. because the sooner you bought treasuries, the cheaper they were. And when prices rose, selling them would yield big profits. In other words, U.S. treasuries became a highly speculative, profit-generating tool. Just take a look at this chart. If you bought U.S. Treasury bonds in 2014, meaning you lent money to the U.S. government, by May 2020, the value of your bond holdings would have doubled. That's a 100% return in 6 years. And because so many people were scrambling to buy U.S. bonds, you never had to worry about selling them. Plus, who owes you the money? The United States, the global superpower. You didn't have to worry about default. That's why U.S. government bonds have long been considered risk-free assets. Think of it this way. In the past, if the value of your U.S. bond dropped, you could simply hold on to it, and eventually it would bounce back. And even if it didn't, once it matured, you could always demand full repayment from the U.S. government. In other words, investing in U.S. treasuries seemed nearly loss-proof, with the potential to double in 6 years. That's exactly why many people use financial leverage to buy more bonds. For example, let's say you had $1 million today. You'd use that to buy U.S. bonds, then use those bonds as collateral to borrow $950,000 from a bank. You'd then use that $950,000 to buy more bonds, collateralize them again, borrow another $900,000, and repeat. Buy bonds, collateralize, borrow more, and buy again. By repeating this loop, some people used 5 to 6x leverage, meaning with just $1 million in hand, you could control up to $56 million in U.S. Treasury bonds. But if you look closely at the chart starting from May 2020, the value of U.S. bonds has been steadily falling. Imagine you're a bank and a client brings you $1 million worth of bonds to secure a $950,000 loan. If those bonds drop to $950,000 in value, that's already cutting it close. If they fall further to $900,000, do you think the borrower would want to repay $950,000 to reclaim an asset now worth just $900,000? Of course not. That's why when bond prices started falling, banks immediately called in their loans. All those investors using 5 to 6x leverage suddenly came under pressure to repay. They were forced to sell off bonds to cover their debts, and this wave of selling in just 3 years wiped out all the gains U.S. Treasuries had made in the previous 6 years. Why did U.S. bonds collapse like that? A major reason is that China and Japan, two of the largest foreign holders, have been offloading massive amounts of U.S. bonds in recent years. The key is this. In the past, people rushed to buy treasuries because they kept rising in price, but now they've entered a bear market. Even major nations like China and Japan are selling aggressively. In recent years, numerous U.S. banks collapsed simply because they held too many losing bonds. So do you still dare to buy U.S. treasuries? The U.S. Treasury is nearly empty and will soon need to borrow more at high interest rates. But even offering high interest might not attract enough lenders anymore. So what now? U.S. bonds are like an old long house. It looks grand, but it could collapse at any time. You can keep patching it up and repainting the exterior, but no matter how much you renovate, the foundation remains rotten and unstable. The collapse risk is still there. But here's the thing. There's another option. Blow it all up and rebuild from scratch. In other words, if you're the U.S. government, You can either keep desperately trying to preserve the bond system, or you can choose to let it all collapse, crash the entire American economy, drag down the global economy with it, and then rise again from the ashes. That way, the U.S. could once again become the fastest recovering economy in the world, rebuilding the system from the ground up. So what will they choose? In 2008, the U.S. chose to blow up the house. And now, once again, we're standing in front of another ticking time bomb, one that could trigger a global economic meltdown. If you've ever felt the despair of the 2008 financial crisis or the panic when U.S. stock markets halted trading in 2020, then you'll understand. People who think this has nothing to do with them might lose their entire net worth on the last day of June. But at the same time, those who understand the real game behind the scenes, they'll be the ones who seize the wealth. If you don't want to become a victim of this financial chess match, if you even want to leapfrog up the social ladder, then follow my channel because I'll be sharing more critical insights like this in the future. And if you're afraid you'll forget everything you've heard, which means wasting your time, you can hit the like button on this video. That way, it will automatically be saved to your playlist, making it easier to come back and take action later. So how can the U.S. government actually solve the problem of rolling over low-interest debt into high-interest debt, while also dealing with the fact that it's running out of money to spend? There's really only one answer, one move that would push the real power players in America to take action. The Federal Reserve has to turn on the money printer. It must print dollars to buy U.S. government bonds and then lend that money back to the government to spend. On top of that, interest rates must come down, ideally to 0%. But here's the catch. Why would the Fed help the government? Because if nobody buys U.S. Treasuries, the U.S. won't be able to pay off the $6.5 trillion it owes. And when that happens, the government would be forced to declare default, basically admitting that those bonds are now worthless paper. Everyone who loaned money to the U.S. would be wiped out. If a global superpower like the United States can default just like that, the whole world would panic and abandon the U.S. dollar fast. Think of it like this. Why do I deposit money in your bank? Because I believe it's safer there than under my mattress. But if your bank suddenly goes bankrupt, meaning I might never get my money back, I'd rush to withdraw every penny. It's the same with the dollar. People use USD not because they trust their own currency, but because they trust that the dollar is backed by the U.S. economy and its government bonds. Take Ukraine, for example. Even in the middle of war, if a Ukrainian holds U.S. dollars, they still have a form of security. That's the power of the dollar. But what happens if the U.S. government defaults and no longer backs its bonds? Then the dollar tied directly to those government bonds would collapse. People would dump dollars in a massive sell-off and rush to convert their money into other safer assets. If the dollar is no longer backed by trust in U.S. bonds, its value could vanish almost overnight. And that's why the Fed has no choice. It must act, not just to save the government, but to save the wealth of the billionaires behind it. If it doesn't, those very people will watch their fortunes turn to dust. In fact, the Fed has already stopped shrinking its balance sheet, which means it's no longer pulling money out of the system. The next step? Expand the balance sheet again. Print money, inject liquidity, and start buying treasuries. It's inevitable, but the Fed can choose how it wants to rescue the bond market. Option 1, the Fed prints money to buy U.S. Treasuries but keeps interest rates high at 4.5%. Some might say 4.5% isn't even that high. But think about it. Previously, the U.S. borrowed at near zero rates. Now they're paying 4.5%, a 400% increase in borrowing cost. And remember, the government borrows trillions. Even a 1% increase costs an insane amount of money. So unless the Fed cuts interest rates, the U.S. government will be stuck working forever just to pay interest to the capitalists holding the bonds. Here's how it works. American citizens pay taxes to the government. The government uses those taxes to pay high interest to the Fed and bondholders. It's a loop where public money flows right back into the hands of the financial elite. Meanwhile, businesses can't survive in this high-interest environment either. If even the government is struggling to borrow at 4.5%, imagine what rate a company would have to pay. 6%? 8%? It's unsustainable. Companies will go bankrupt. Jobs will vanish. Spending will drop. The economy will contract. Stock and bond markets will collapse. And guess who's been preparing for that? Warren Buffett. He's dumped U.S. stocks and is sitting on a mountain of cash in short-term bonds, 3-month to 1-year treasuries. Why? Because when everything crashes, the U.S. will still have to repay him with interest. Then with all that cash, Buffett can swoop in and buy American assets at rock-bottom prices. Let's go back to our metaphor from before. Imagine the U.S. bond market as an old, long, crumbling house. You can paint it, patch it up, just like how the Fed props it up, but it's still the same old structure. No one wants to buy it, and interest rates are the noose that the capitalists use to choke the U.S. economy. Trump knows this. He's never begged the Fed to print more money or expand the balance sheet. He's only ever asked for one thing: lower interest rates now. But the Fed has made its position clear. We won't cut. So what's left? Blow up the house. Let the bond market crash. Let the stock market crash. Let the dollar fall. Why? To force the Fed to not only print, but to print faster and bigger. To slash interest rates to near zero. Because when the market collapses, if the Fed hesitates, it won't be able to save it at all. And that bomb is already ticking. It's called the global tax trap. The smart ones already see it. Whether the Fed cuts slowly or Trump forces them to cut fast, the end game is the same. U.S. assets must go through a sharp downturn, maybe even a collapse. But do you know what? Every crash is a moment of wealth redistribution. In the 2008 financial crisis, some jumped off buildings, others bought the dip and got rich. In the 2020 pandemic, small investors got wiped out, but hedge funds made 3x returns easily. This year's crisis could be the last chance for ordinary people to change their lives. Why do so many people lose money during a market crash? Because those not holding stocks blindly try to buy the dip and end up catching a falling knife. And those holding stocks either panic sell at the bottom or stubbornly hold on, waiting to recover, but never do. In the end, they miss both the crash and the rebound. If you still believe in outdated strategies like hold long-term and it'll bounce back, then this era will crush your wealth. That's why you must learn how to identify a market top before the crash, to lock in profits and catch the reversal. The key point is, just because the Fed hasn't cut rates yet doesn't mean they won't when the crash comes. Right now, U.S. stocks, bonds, and the dollar are all dropping together while gold is soaring. Isn't that exactly the script that was planned from the beginning? Step 1. Weaken the U.S. dollar. Imagine there's a house worth $1 trillion. Sounds expensive, right? But what if I told you that $1 trillion is worth just one Vietnamese dong? Suddenly it's dirt cheap. So when the dollar loses value, so does the price of everything denominated in dollars. The same applies to U.S. debt. The U.S. has to pay $6.5 trillion in June. If the dollar has already devalued by 10%, hasn't that shaved off 10% of the debt burden? And that's only based on current numbers. If the dollar keeps falling until June, America will pay back even less. So how do you make the dollar crash? By triggering a U.S. stock market crash. This forces global capital to flee the U.S., causing a massive sell-off of dollars. If the U.S. wants to reduce its June debt load, doesn't it make sense to crash the market once or even twice before then? Step 2 is to push gold prices way up so that both the dollar and other global currencies lose value against gold. Why? Because in step 1, Other countries' currencies rise against the dollar. But if gold rises even faster than those currencies, then everyone is losing value, except gold. Is gold going up a bad thing for America? Actually, it's great. The U.S. holds over 8,000 tons of gold, the most in the world, more than the next three countries combined. And that's just America's own gold. Many countries like Germany store their gold at the U.S. Fed. Altogether, there could be around 15,000 tons of gold under U.S. control. Not long ago, the U.S. even imposed tariffs on gold imports, forcing other countries to rush their gold back to U.S. soil. So when gold prices skyrocket, it's great news for the U.S. because that gold just became a lot more valuable. So when no one wants to buy U.S. bonds anymore, it's fine. They can buy gold, which is also a U.S. asset. In other words, in step one, the U.S. weakens the dollar to pay less debt, but it also holds gold. So in step two, as gold surges, it offsets the losses from the dollar. One goes down, the other goes up. Balanced. I've broken this strategy down in detail in a video from 2 months ago. You can check it out later. Step 3 is to use global tariffs to trigger an asset and currency crash worldwide. Then the Fed will expand its balance sheet and print money to rescue the markets, redirecting global capital back from gold to U.S. assets. What does this mean? Let's review the timeline one more time. It becomes crystal clear. The U.S. has to repay $6.5 trillion in June. The tariff hike is postponed for 90 days, meaning it resumes in July. So the weaken the dollar to reduce debt phase ends after June. As mentioned earlier, if there's another U.S. market crash, it'll likely be around June. And when tariffs kick in again in July, there could be another global crash.